Well, thank you and good afternoon and welcome to the DoubleLine Income Fund Webcast with Ken Shinoda and Morris Chen. The title of today's webcast, The Rate Hikes Are Coming. I'd like to announce a couple of upcoming webcasts. And again, you can go to the doublelinefunds.com website to see the full schedule for 2022. But we have our closed-end fund webcast coming up on July 12th with our very own Jeffrey Sherman, who will discuss all three of our closed-end funds, the Income Solutions, Opportunistic Credit, and Yield Opportunities closed-end funds. And then on July 26th, we'll have the Infrastructure Income webcast with portfolio managers Andrew Su and Damian Contes. If you'd like to receive today's presentation slides, you can go to the player, click on Request Webcast Content tab to get those presentation slides. You could follow us on our Twitter handle at DLine Funds, and we do have a YouTube site as well under DoubleLine Funds or DoubleLine. Want to highlight some thought leadership. Again, you can go to our YouTube channels, DoubleLine or DoubleLine Funds, and we have a geopolitical roundtable with Bill Campbell and Valerie Ho, moderated by our Deputy CIO, Jeffrey Sherman, and then our very own Ken Shinoda has Channel 11, and both of those, again, on our YouTube channel. We do have two podcasts. We have the widely acclaimed Sherman Show podcast and also the Monday Morning Minutes with Sam Lau and Jeff Mayberry. Those are available on doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. Today, Mr. Shinoda and Mr. Chen will be highlighting the DoubleLine Income Fund, and here you can see the different expense ratios and minimums for that fund. They will, the standardized performance in the DoubleLine Income, the fund is getting close to 3 years, but the inception was September 3rd of 2019 through May 31st of this year, minus 2.21 versus the Bloomberg Ag at minus 1.52. I did want to highlight the standardized performance on the total return bond fund because we will be doing some comparisons in the material today. So that fund launched on April 6th of 2010 and through May 31st of this year, 4.34% annualized versus the Bloomberg Ag at 2.66. So without further delay, I'll turn the webcast over to Mr. Ken Shinoda.
All right. Hey, everybody, and welcome to the mid-year webcast for the Income Fund. And give me just a second here to get to the slides. So for those that are new to the Income Fund or have not joined us for previous webcasts, you know, why look at the Income Fund? It's a diversified source of income where we're focusing on securitized assets as opposed to corporate credit alternatives in things like high yield and bank loans, which are other places you can get higher yields in the corporate credit markets. Focusing on these structured credit assets, we typically have lower interest rate risk in those assets, so it gives you some protection from rising rates, this year being no exception, with higher quality, longer duration assets faring the worst in this rough market we've had to start the year. And it's a complementary addition to the traditional core fixed income portfolios, giving you that diversification, giving you a potential for higher returns. And surely, at least year to date, it has provided diversification away from the more traditional parts of core fixed income, treasuries, investment grade corporate bonds, and agency mortgages. So I think through time, if the market stays like this, then we'll probably be going up the capital structure here to pick up yield versus yesterday. Massive repricing across the yield curve here. On the upper left-hand side, you have the 2-year, the 5-year on the right. Bottom left is the 10-year. Bottom right is the 30-year. We broke through the 2018 highs across the curve intraday on the long bond. The long bond intraday got up to almost 350. It closed below the 2018 high. So I guess there's a lingering hope that the long end is going to hold that 2018 level. But across the curve, after the inflation print that came out 2 Fridays ago, there's been a rethinking by markets of where the terminal Fed funds rate will get to, where the Fed will basically hike rates this cycle. And the market clearly believes that they're going to get past that 2018 level. Here are returns year to date. The best things have been floating rate assets, higher quality floating rate assets. You can see levered loans and the double B portion of levered loans, and triple A CLOs are the best performing assets. The worst performing asset has been EM, almost down 20%. But really, investment grade corporate bonds, if you look at the ag, that's really been what's led to the largest declines. The index as a whole almost down 15%. Agency mortgages and treasuries actually down less, down 10%. And that's that spread widening that I talked about. So part of the move in the price action of bonds has obviously been interest rates, but spreads have also widened, and corporate bonds have a very long spread duration. It's really been the worst year ever, going back to the inception of the ag to the early 80s. So just to everyone needs to put that into perspective. I think that after this big repricing, the future returns for investors across fixed income, not just the income fund, but across fixed income, are much more interesting than they have been in a long time. And just to put that into actual hard numbers, some of these are pretty remarkable. This is the year over year change in just absolute yield. I didn't put any spreads on this, but the one I have been using the most recently just simply is saying, look, some poor soul bought AAA bonds off of this new issue, non-agency securitizations. They're very short bonds when rates are low, at a 1 yield 1 year ago. And with short-term rates up over 200 basis points and spreads wider in some parts of the market by almost 200 basis points too, those same bonds, same risk, AAA, yield almost 6% today, 5.7% as of about a week and a half ago when we put this snapshot together. If you go down the capital structure, the double Bs of RMBS securitizations yielded less than 3%. They're yielding almost 9% today. And it's the same story across not just residential credit, it's across all parts of the market. CMBS AAAs that yielded 2 yield almost 5. CMBS triple Bs that yielded 3.5 yield almost 8. You go to ABS, same story. You're about anywhere from 3.5 to 5.5% higher on average in all-in yields across the securitized markets, partly because of rates, partly because of spreads. You would actually think we would be down more in price in the income fund because you see these big movements in all-in yield, and you see the move in the treasury yield curve, and you say, well, how come corporate bonds are down 15, but these securitized assets are not down as much? Well, we're just shorter. We're shorter in structure because of the cash flow waterfall. So instead of having a spread duration of 6, 7, 8 years in corporate bonds, sometimes even longer, we've got much shorter spread durations. And we had a lot of carry. So the carry helped cushion some of the blow. And we've only earned half the carry for the year. So as time passes through the end of the year, we're going to have even more carry come in that can help to create more return in the portfolio. So this, I think, is a great page. People need to take a hard look here. And I know there's risks out there. I know there's recession on the, people talking about recession on the horizon. The risks are obviously higher for recession now than they were 6 months ago, but the potential returns in fixed income relative to equities perhaps are an interesting thing to think about. Not only has credit cheapened, agency mortgages have also cheapened. We don't own a lot of agency mortgages. This is nominal spread, not option adjusted, but nominal spreads outside of like a day in 2020 that we haven't seen for almost a decade. So very high nominal yields relative, and this is almost on par to corporate bonds with no credit risk. It's prepayment risk. And to put on top of that, the prepayment risk as measured by convexity this is the mortgage-backed securities index convexity. So the lower this number is, the more call risk you have, the more negative convexity you have, which is if you're an advisor and you're investing in munis, you know this very well. We have the lowest negative convexity in the index, I think, ever, because of just the mix of assets that's in there. There's so many low coupon mortgages. So not only is credit cheap, agency mortgages that had been rich for a very long time got extremely rich, as you can see by this chart. 2021 look very attractive and interesting on a relative value basis, I think, to some other high quality assets. So I talked a lot about negative performance of fixed income assets. And one thing people always say is, if it's negative return, or do you have losses? Well, no, this has been all about interest rates moved higher, spreads have widened. Nobody's taking any losses. We don't have, defaults in any of these bonds. But what we have is a lot of security in these assets that we own. So this is a slide that shows you what's currently delinquent in these portfolios. You can see very low delinquencies, sub 1% across CLOs and ABS, a little bit higher from CMBS, still recovering from the pandemic. RMBS, we own some bonds backed by reperforming loans and non-performing loans, and those bonds kind of drag the delinquency rate up a little bit on this. But next to that, in the dark blue, you see what's called credit enhancement. This is hard collateralization of bonds below the bonds we own that need to get fully written down by losses before we get hit. So even if things get worse economically, of course delinquencies will go up. They need to go up a lot for us to get hit. And we believe that most of our securities, if not all, are highly unlikely to take principal write-downs given where we sit in the capital structure and the underwriting that we've done on these credits. And we're going to talk more about the state of the different pockets of the market over time. But before we do that, let's talk a little about the economy. I found this on, I thought this was perfect for where we sit today. Everywhere you go, you hear about rate hikes. Turn on the TV, you open your phone in the middle of the night. It's all over the place. Rate hikes are coming. The rate hikes are coming. And here's, I guess, Paul Revere coming to warn us that the rate hikes are coming. And instead of riding a horse, he's riding the snail that is the U.S. economy that's growing ever so slowly. And that's where we're sitting. We're sitting in an environment where the Fed's hiking rates and the economy, it's clearly slowing down. Atlanta GDP now for the second quarter coming close to zero after a negative Q1. And you have real GDP forecasts. Look how high we were for 2022, way back in the middle of 2021, and how far the market's expectations for growth continues to come down. And of course, this is a lot has to do with inflation and the demand destruction that inflation can create. Last time on our last webcast, we spent some time walking through the components of inflation. Back then, services and shelter hadn't picked up yet. We thought they would because of supply-demand issues in both those parts of the market. We thought core goods would come down. It has a little bit. I think core goods keeps coming down. I think demand is weakening, and a lot of that core goods type purchases activity. I mean, how many cars do people need to buy? Used car prices are definitely starting to drop, talking to some people in that industry. The things that are not potentially dropping that people need to have their eyes on, and we've been talking about here at DoubleLine for quite some time, are the shelter component of CPI and the wages that push into services. Here's home prices to rent. Home prices are obviously gone through the roof. I think home prices are going to stop going up here. I'll walk through why in a little bit. But there's a lag between home prices and rent. We just got rent increases nationwide, 14%, extremely high. Some Miami was over 40% on a year-over-year basis. So there's a lag to home prices. And now with mortgage rates higher, mortgage payments are higher. That's going to also, I think, pressure rents higher too. And I'll let my colleague Morris touch on that when he gets to commercial real estate. So this is reinforcing the fact that shelter component of CPI probably stays elevated for at least the near term. Home price appreciation leads to rent inflation. Here's another way to look at it. This is just the core logic home price relative to shelter component of CPI year over year. Doesn't look like it's coming down based on this chart. This is the supply demand imbalance in the workforce. This is why wages continue to rise. We've got way too many job openings relative to unemployed. It's the largest gap we've seen going back to the 2000s. Some of this, I think, is demographics. And I brought this up in the last webcast 6 months ago. There is a long-term trend downwards. This has to do with the baby boomers leaving the workforce. They may come back. A recession and a stock market that's down 20, 30%, home prices down. All that could lead people to come back to the workforce, just like the global financial crisis. I'm not saying that is my base case that everything's going to go down and everyone's going to have to come back to work, but I'm just saying that this has been a long-term secular shift demographically. People could come back to the workforce. You do see that the employment to population ratio is on the rise, but unfortunately, there's other things working against us other than the baby boomers retiring. We have totally put a hamper on immigration, and I know it's a hot topic. I'm not gonna, I'm gonna keep my opinion out of it. I'm just gonna state that you're taking people out of the workforce, and that's gonna put pressure on wages. So that's something that I wouldn't be surprised if people's opinions and the country's view on immigration perhaps changes at some point as we want to bring more willing and able workers into our workforce to help bring down inflation. I think that could be something that becomes a hotter topic as we come down to new elections down the line. And as a function of this inflationary pressures that I brought up, look at the change in the market's expectations of Fed funds. It's doubled. This is on the far right-hand side on the y-axis, that's rate hikes, right? So every two would be 25 basis point rate hikes. But basically, the market's expectations of rate hikes has now doubled since about March to about 16 hikes through February of next year, I guess this is, I can't see the number, it's probably like 13 hikes through the end of the year, getting us to a 3.5% Fed funds by the end of the year. And just look at where that was at the beginning of the year. But it's all about inflation and the numbers coming in hot. And that last number, just everyone was hoping for a lower number and it coming in hot. That's really changed expectations in the market. And that's why you saw such a big sell-off in risk assets and a rise in yields. So let's get to some good news. Everywhere I go, I feel like I just read bad news. So let's talk about some good news. Consumer is, I still think, in a decent spot relative to their ability to pay debt. They, of course, are getting squeezed in their discretionary spending, as you saw in the retail sales, although part of retail sales was also a seasonally weak time of year. But thanks to stimulus, there was a ton of built-up savings. This shows the savings kind of in bank accounts starting basically at the pandemic. So now you have like $2.5 trillion in bank accounts. You heard Brian Moynihan of Bank of America, I don't know, like a month ago, was talking about how like an average person that had $3,000 in the bank pre-pandemic now has $6,000. The average person that had $8,000 in the bank pre-pandemic now has $16,000. So they've got money in the bank. The problem is if inflation stays high, food prices, energy prices, they're going to start dipping into that. And you're starting to see that looking at the spot savings rate number. You're starting to see that looking at credit card balances going up. So obviously the high inflation, food inflation, energy inflation being the two main, and shelter, of course, that is starting to squeeze the consumer. So that's the bad thing. That's going to hurt that 2/3 of the U.S. economy discretionary spending. But we in the income fund, we don't own Best Buy. You don't own Best Buy stock, so they might not be buying stereos and TVs, but they're paying their credit card bills and they're paying their mortgage payments. Here you can see household financial obligations. So this is like credit card debt, auto debt, student loan debt, mortgage debt, as a percentage of disposable personal income. And I know it's kind of a weird, funky metric, but just hang in with me. It's the lowest it's been since the 1980s. It's actually even lower. So this just shows you kind of the leverage at the consumer. So that looks good. So the consumer has a lot of savings. They're getting squeezed by inflation. They're not buying. They may maybe spent enough on goods that could help core goods inflation. We just want to know they're going to make their debt payments a little bit. They're still below 2019 pre-pandemic levels. So that's good. We'll keep our eyes on that. Underwriting quality is still very high. This shows you mortgage credit underwriting. Just focus on the very bottom, the dark blue. That shows you percentage of loans less than 620. If you want to look at both blue shades, you can do that too. It got up to about 25% of production in 2007 was subprime, 650 FICO, in this case 660 FICO or lower. That is now looks like 5%. So the credit quality of underwriting remains extremely high. This is good for the housing market because it means less defaults potentially in case things get worse economically. Housing has definitely gotten more unaffordable. This is housing affordability as measured by the average mortgage payment on the median house based on median income. It's the worst it's been since '05. This is why all the housing data is slowing down, right? Mortgage rates have doubled. They went from, they're actually almost tripled, but they went from like, at one point you could get a 30-year fixed rate for 2.5%, and now it's 6%. So it's more than doubled. And home prices are up 35% from April of 2020. So this has made affordability really low, and that's why you're seeing this big slowdown in housing activity. Could housing drop in some places 5%, 10% in price? Sure, but it's up 22% year over year. So I don't think that's too big of a deal. Some places it may not even go down. We just saw the first decline. I think it was in Detroit year over year, was the only metro out of 20 metros that are covered in that housing price index that was down. And the reason I don't think you'll see big declines like the global financial crisis, a couple of them, but the main driver is inventory. There is just very low inventory. We're sitting at just over 1 million units of existing inventory. This has been the big driver of home prices going up, low supply, demographic demand. When we hit the financial crisis, and that's the left red line, you were kind of like in the middle of Gen X. And Gen X was a declining percentage of the population of people hitting in this analysis that we have. It's 33 years old, which is when kind of the most households are formed. And now you can see millennials, this is actually trending up. More people are hitting 33 years or older over the next couple of years. So you have millennial demand, very low inventory. The headwind is that affordability metric. And let's say things do get worse and we do go into a recession. We've got a playbook now, which is mortgage forbearance. I definitely do think that in a recessionary scenario, the Fannie and Freddie and Ginnie Mae and the FHFA and HUD, they're here to get people into homes by making mortgage rates lower. They're not here to get people kicked out of homes either. So the global financial crisis, we didn't move as aggressively on things like forbearance and modification. The mortgage ecosystem was not set up to modify millions and millions of borrowers. But thanks to having gone through the global financial crisis, these mortgage servicers are really set up to do this type of activity, and they did. And you can see we put all these borrowers into mortgage forbearance, and they all started healing. And we've got that delinquency rate way down across all these subsectors here. You can see the total number here down, basically around where the unemployment rate is times home ownership, which is about 65%. So I think if things get bad, mortgage forbearance programs will probably be used again. They'll definitely be used in private label securitizations because most of the equity is owned by funds that don't want losses. So they'll go through those forbearance programs. Another thing that keeps people from defaulting is equity. We have the most equity in homes ever, over 26 trillion of equity. So borrowers, this is cash. They're not going to walk away from it. So they're not going to just throw the keys back. They may rent the house, take the rent payments and go rent somewhere themselves, maybe a little bit more affordable, or they just sell the house. So I think a combination of forbearance and the equity that you see in homes, you don't get the strategic defaulters. That's going to limit the supply of homes in the marketplace too, which all those things will help support housing. Could home prices go down? Sure. But we're not going to see a global financial crisis type scenario. At least that's our opinion, based upon the state of not only the supply demand fundamentals in housing, but also the mortgage ecosystem. And last but not least, we want to show you that our LTV of the loans that we own, weighted average LTV is 77. So this is the weighted average LTV of kind of the borrowers. So they all have about 30+% equity. The one that stands out is single family rentals. Those are institutional investors. Relative to the bonds we own, our LTV is kind of like 85 on those. But LTV is not only is there low LTV, on top of this, we have that credit enhancement that we showed you. So first, all the equity needs to be wiped out, and then all our credit enhancement needs to get wiped out. And that's very improbable, we think. So that's the housing market. That's the consumer. We have both exposure to residential mortgage bonds that are not government guaranteed, so we're exposed to the consumer's ability to pay that. And we also have some consumer receivables, and both those I think we feel very comfortable with. The yields are much higher, and we think the credit should perform okay, even if there are tough times ahead of us. So I'm going to turn it over to Morris now to cover the commercial real estate market.
Thanks, Ken. So as we look at the commercial real estate market, we kind of start off here. We're looking at transaction volumes, and I think there's some clear trends that's going on. Clearly, they're in the backdrop. We're seeing borrowing costs go up for borrowers, and that's partly due to the recent interest rate moves within the commercial real estate market. As a function of that, year over year, from a property transaction perspective, we're definitely seeing a drop, significant drop, and that's succeeding a banner to 2021, a banner latter half of 2020 as well, second half of 2020, where transaction volume ballooned, as you can see on the left-hand side of the chart. So, for us, the first move in terms of thinking about commercial real estate is transaction volumes has dropped. A lot of it's due to a disconnect between buyer and seller, and I would say that's the first sort of move that we're observing within the markets. And not to when you think of commercial real estate, you can't ignore cap rates. Cap rates are essentially the yield, effectively the yield on a commercial real estate property. And here we're just comparing the basis between what cap rates are, where cap rates are historically and currently relative to the 10-year U.S. Treasury. And I would say that basis on a historical standpoint has compressed in a meaningful manner. I think all if you kind of combine the first chart relative to this, I think the telling sign is that we'll likely see some trailing off in terms of commercial real estate prices and potentially a little bit of a drop off in terms of price action. But as with all good things, as we're thinking about the commercial real estate market, you also have to think about what's going on in terms of property prices and property cash flows. Here we're talking about, we're looking at the major food groups: apartment, industrial, office, retail. Net operating income, this NOI growth, it's essentially the cash flows that the properties are generating. On a national scale, I would say it's been robust, since the pandemic, especially the latter half of 2020 and then into 2021. We saw material growth in terms of NOI and cash flow, particularly in the apartment housing sector. We're still seeing some meaningful growth on a month-over-month basis within the multifamily arena. And that kind of segues into, piggybacks off of the tailwinds that we observed in the residential housing market, where affordability, as well as housing prices, the house increase in terms of housing prices and dampen affordability in that residential market has translated and permeated into the apartment market, where where a prospective buyer of a single family home that can't afford a home has now the option is to rent. So for us, we do and are very constructive on the apartment arena. We continue to do so. And that's part of the reason why we're observing such strong growth. Obviously, the industrial market has done an exception as well. That's largely due to the transfer in terms of internet to brick and mortar, and as well as brick and mortar to the internet sector. Pandemic has kind of expedited that process in terms of transferring, and as a function of that, the need for space in industrial has benefited. But the bigger takeaway in itself is, yes, we do have inflation in the backdrop. As we think about the commercial real estate world, you have to pick and choose properties that are able to increase cash flow or increase rents. And the shorter the leases affords a borrower and/or specifically the owner the ability of that to drive and increase rents. And so short-term leases, as we think about commercial properties, our apartments, they're generally speaking on 1-year leases. Industrial, 2 to 3 year leases, depending on the type of tenants. And then also, hospitality, which is, leasing rooms on an overnight basis. So contrary to the thought process of the type of pain that hospitality went through during the pandemic, hotels are actually doing quite well. As we're looking at commercial mortgage rates relative to historical averages, we can't ignore that the borrowing cost has gone up, irrespective of what the property types are. This is just to give everyone a little bit of a sense of caution that yes, higher rates absolutely does affect commercial real estate values. Now, with that said, values can also be offset, as we kind of discussed in the previous slide, by growing cash flows. And I would say that, as we're looking into the horizon in terms of the commercial real estate market, there definitely is, it's easy to blanket that commercial real estate properties will be challenged. But I do think that it's a lot, that specific thought process, it's a little more complicated. Certain property types can and will be challenged, such as office. But apartments, just given the backdrop in terms of shortage of housing, what's going on in the residential market, in the single family rental market, and then in conjunction with some sort of shift in demand from high tax states to low tax states, we will and likely see apartments to continue to do fairly well in this environment. So yes, borrowing costs are high. Yes, it does affect borrowers. But we're not expecting any sort of cataclysmic effect for certain sections of the commercial real estate market. I do think that office will and can potentially be impacted in a more material fashion. That is largely due to two dynamics: the switch from hybrid full-time to hybrid work, and then in conjunction with just availability of capital. The most difficult prospects in terms of what we're observing in the market right now is more about finding lenders and availability of capital for lenders to want to lend against property types. In this environment where there's a lot of uncertainty in terms of interest rates, as well as uncertainty in terms of macro economic outcomes, you're often seeing lenders be a little more hesitant to provide loans for office properties or create more of a tighter lending condition that in itself does impact values, and we'll probably see some office properties, largely the Class B older office properties be impacted a little more. But that's not to say that the overall market will be we're concerned about the overall market. But overall, from a property price index perspective, similar to the residential, we've we've increased year over year in a material fashion in terms of price increases. So while property prices may come down by 5, 10 to 15%, this in our world, as we're kind of looking at this through the lens of a lender or and kind of tying up the commercial side, given the exposure within the fund. This is a way to compare, where we stand within our commercial real estate holdings relative to the level of protection that we have. I would just focus on, there's two parts: the LTV, which is loan to value, and I would say the debt yield. To understand debt yield in itself, just think of it as what the yield of the property is if a lender were to foreclose on the property. So meaning if I were a bondholder, I would foreclose on the property, this would be the yield I would receive. So essentially the cap rate, but as a loan holder. And so, simplistically speaking, if you think about where we are as a cycle, on the bottom, you're seeing apartment cap rates as low as 5%. You're seeing historical average cap rates in the 7% range. We, in terms of our investment holdings, from a bond level holding perspective, in terms of cap rates, we're in the 12s, 10s, 16, 11, depending on the property type. On a weighted average basis, we're about 13%. If you want to comprehend where cap rates need to go for us and where we own these properties. So I think it's very powerful. There's a lot of room for in terms of cushion. I think from our holdings perspective, we're very, very comfortable. I do think that given what's going on in terms of the increase in yields, from an offensive perspective, there's definitely a lot of opportunities in the commercial real estate area. We do like, the backdrop with uncertainty. We understand that. That's, part of the reason why there's tiering in terms of collateral. But I would say that there's, from a investment perspective, there's also a lot of investments to be made and to be had, just for all the reasons that we discussed. As we're looking into other areas within the economy, we're focusing on transportation. Given some of our exposure within the transportation market, here you're seeing TSA travel throughput on a year-over-year basis. Just focus on the left-hand side, you're seeing 2019 levels in the dark blue, and then in the lighter blue, you're seeing 2022. So definitely month-over-month increase in terms of travel. I think for everyone, that's planned travel. At least people I know, as well as a lot of people we talk to. There's definitely a lot of summer travel plans ahead, and we're hearing of a pickup in activity that's ongoing in this area. That's part of the shift from sort of goods demand to services demand, and as a beneficiary of that, a lot of our aircraft holdings will be the beneficiary of this fundamental change, which kind of brings us back to some sense of normalcy. And then kind of moving on within the corporate credit market, this is, gives you everyone a bit of a risk barometer as we're looking at high yield and the leveraged loan market, high yield in red and the leveraged loan market in black. We want to focus on this is largely because we view these two areas as a risk barometer for credit markets. Yes, there's been spread widening. High yield market has, currently, as it sits right now, as of last week, end of last week, was about 477 over in terms of spread. If you just look at historical context, absent of the global financial crisis, but just look at historical widening context in itself, spreads kind of, typically widen and then shoots up to around 800 over on that within the high yield market, and then very, very, very quickly gaps back. I think the point here is that, yes, while there is spread widening, at some juncture, we do think that investors should dip their toes in terms of fair value. And usually that, the spread basis in the high yield markets around 500 to 600 over. It's just impossible to time the bottom. But with that said, as an investor that's thinking about longer term horizons, spreads are heading that route. And then, looking at credit tiering, double Bs and triple C spread differentials has continued to widen. Triple C rated high yield bonds have widened in a meaningful manner. This kind of gives a sense of some credit tiering involved and investors pricing in a potential slowdown within the economy. And then looking at within our portfolios, we do have exposure to corporate CLOs. This is an area that's done well, both on a year-to-date basis as well as within 2021. I would highlight that within the corporate CLO market, while it's an $800 billion market, on a historical context perspective, prices have fell in recent contexts. That provides a lot of total return in terms of upside. And the way we're looking at default rates in itself, corporate default rates are extremely low within the bank loan market. Yes, it can go up, especially as recession probability continues to increase. But we do feel that the corporate CLO structure has proven itself. The managers that investors hire and select in terms of have exposure to, have the ability to manage around the corporate CLO structure. And then on top of that, the guardrails within the CLO structure affords managers ability to curate the best profiles possible. So from a opportunity standpoint in itself, we do think that there's definitely some opportunities. And then just think about historical defaults. Only during the GFC did defaults creep up into the 10% range within our holdings.